The following show is intended for mature audiences. Viewer discretion is advised.
We are live. Coffee with the John, Season 3, Episode 5. Welcome to the live stream of Coffee with the Johns, where we share strategies. We're sharing the news, headlines, things that are happening in the market that are going to affect the way you invest in real estate, the way you manage your portfolios, the way you look pretty much at the whole world. After this episode, you're not going to look at the world the same again. Was that too dramatic? A little bit. Your host.
Is that your common sense again talking?
I'm your host, Jonathan Barbera, and with me, as always, is co-host extraordinaire, Mr. John, aka Fun Facts Bar. And we got a lot to cover today. We have a lot to go over because the mortgage interest rates have pretty much doubled. It's scaring the crap out of builders, investors. A lot of people are pressing the pause button. They're not sure what to do, where to invest, where they're gonna go. All of this. It's just it's a lot going on in the market. There's a lot of people doing what your boy Dave Ramsey calls fear porn. So we're gonna cover a lot of the articles, a lot of the trends, a lot of the things that are happening. We're going to show you why so many people are scared and why so many people are panicking. We're going to show you why it is that we're really not panicking and how to prepare. I mean, that's really the biggest thing is how are you going to be able to prepare, predict, and understand what's coming down the line, and how can you just not avoid losing everything, but also succeed and thrive in this changing market, changing economy. So with that being said, if you're joining us live, make sure you join the chat. Let me know where you're listening from. If you have any questions, if you have any thoughts, opinions on the market, on what we're saying, participate. We're always reading the comments and trying to get back to you in a timely manner. So with that being said, Mr. John Barr, how you been?
I've been absolutely fantastic.
Absolutely.
Yeah. Get a nice hot summer breeze, no rain. I mean, this is great. The market's still doing what the market does. A little shaky, but the stuff we've sold still been moving along just fine.
Right. And we're going to talk about that. We're going to get into more details on that, on the stuff that we've been selling, what we've been seeing ourselves, because I mean, we were worried, we were worried about, and we still are cautious about how the market is. So to kind of jump into all this, this week we listened to a presentation by a local economist in especially in the real estate market. His name is Dr. Mark Dotzer. So he's many of you may know him. He did a presentation for Keller Williams, and he went over a lot of information. And his overall point of view on the market is, I would consider it to be pretty bullish. He's not worried about really anything that might happen. He's not.
Well, he's not thinking short term.
Right.
He looks at historical data and just because he looks at it as what housing's meant for. It's meant for shelter, not meant to buy it, make a bunch of money in a year, and turn around and sell it again, or buy it, immediately rent it out. It's meant for you live there for 3 to 5 years, 10 years, whatever it is. You're supposed to buy houses to live in. You're going to be there for a while, not buy it because, I'm going to stay here for another year or two, but I don't want to rent for a year or two. I'm going to buy a house and I'll turn around and sell. That's not what housing's meant for. And so he's got a longer term out view on it. So he's not that worried because, next 6 to 12 months, 18 months, he even says it, he even shows that prices might fall a little bit, but look what happens in 2 years after it starts, 3 years after it starts. He did a nice graph of what the San Antonio prices does, average sales price compared to sales volume. And this presentation was typically to a bunch of real estate agents.
Mm-hmm.
And yes, sales volume drops by 20-30%, but prices, I think, as of 2008, the average price was $207,000. 2009, it was $201, so it dropped $6,000. And 2010, it was $210. So it's in 2 years, it was already higher than it was in 2008. So it's already like it didn't. It
I mean-
kind of just dropped a little bit, and then
Yeah.
and then by the time 2011 came around, it was 211. 2012, 223. 2013, 247. So like between 2008 to 2012, it was already 223,000. It had already gone up to $16,000.
And that's, I think
10%.
that's the biggest point, like that I look at, and am curious to get your feedback on, is we've watched a lot of people do these kind of presentations. We saw PBD do one recently as well. My issue when they use the 2008 data is that, in my opinion, this isn't 2008. You know, when they look at San Antonio in 2008, it barely, went down a little bit. So we're doing good. And it's like, well, San Antonio isn't now what it was in 2008. Like,
But it wasn't the same in 2000 or 1990 or 1980, and it did the exact same thing the last 4 recessions.
Right, but this last time we've appreciated tremendously. In 2008, leading up to it, you didn't have that tremendous appreciation that we've had in the amount of people. Like, we're seeing a big shift in the overall market where more people want to move to Texas from ever before. Before, you had other states that were more appealing than Texas. You even had people back in 2008. There were more people moving to California. That was the place to be and all that. Now Texas, Florida, they're the places to be. So we're having a huge influx of people. And I'm not saying that this justifies a market drop. I'm just saying, like, I don't think the data, you can use the 2008 data as a benchmark for what could or could not happen to San Antonio. I think they're different crises. I think the market was in a different place then than it is now.
Well, I think we're in a much better position now than we were in
I
2008.
agree. I think where we are in San Antonio, where we are in Texas, I don't think that data even matters, right? Because, like, you look at the market, you look at the Texas market, what is the biggest thing that we've talked about in previous podcasts is that it's affordability. Texas, when you compare it to the coastal cities and everything, is by far the most affordable place to live at. And you have affordability not just in housing, but affordability of living. You have a lot of the companies that they're following pretty much where the employees are moving to. So you have a lot of major corporations coming down to Texas. So that's going to be creating even more jobs. So it's increasing the pay on the jobs. It's increasing the salaries. So, I mean, you're looking at all those things. That's like, when you look at 2008, I'm like, I don't think that even matters.
It's just what you can go off of. And that's what I say, you have nothing else to base data on. Otherwise, it's a prediction. I mean, you look at the history, and then it says, well, it's not going to be the same thing, but it's probably going to be pretty close. It's going to rhyme. Like, how has it done the last 3-4 recessions? And it's like Texas, or especially San Antonio, has done tremendously better than even the other 3 major metros. It's like, we never boom as high, we never drop off as far. And you can see that with, like, you go back and you look at several of the market updates I've done, like what Austin's done. I mean, it was appreciating at 40% year over year for like several months in a row. And it's like, that is insane. Yeah. So they're even more drastic than we are. And that's why Austin tends to boom more and drop off more. But I was talking with a friend of ours who owns a company up in Austin, and he's a CPA tax background. And he's like, dude, every time I talk to somebody that's moving here, they're making $300,000, $500,000, $600,000, $1 million salaries where he lives at. It's like, people are still moving here, and they're moving here with big salaries. And that's why prices have jumped like they are. Because, like, people aren't just coming with cash from the coasts. They're coming with cash and salaries.
Yeah.
To support that, because there's jobs relocating here. Now, I would not want to be living in like a coastal city right now, because you look at, I think it was the PPD that, I think it was him and his podcast that he did of like the states that lost population.
Yeah.
And it was like California, New York, New Jersey, Washington,
Chicago,
or Illinois was another one. And that is something that would worry me, because you look at it, it's like, yeah, California's prices have been booming the last couple of years, but they're losing population.
Yeah.
Texas, he's been booming the last couple of years, but we're gaining population. There's nothing worse in the real estate market than losing population, because you can build houses, but if people are leaving in droves, that's 2 headwinds.
So one of the things that I think we should address first is this is why we do the podcast, to hopefully help you understand how to look at the news. It's not for you guys to listen to us and do what we say. It's for you to not listen to anybody, but to really become a researcher of the data. Really look down. Don't just look at the headline, but go deeper on the headline, because there's so many headlines that we see about there's a bust in the market coming, the real estate market is in a bubble, this and that. And then you look at it and you're like, where though? When you start looking at the data, it makes no damn sense with the data that they're putting out on why the market is in a bubble. So do you think the real estate market is in a bubble? Like, why is it not in a bubble? Why do you think the real estate market is not in a bubble, or is? What do you think?
I don't think it's in a bubble, but we have had a very accelerated rate of appreciation these last couple of years. And the tax rates haven't, I've mentioned this in the past, like tax rates haven't caught up to those because they lag behind a year. It's like, I think it's not in necessarily a bubble where you're going to see prices fall 10, 20%, given that the Federal Reserve doesn't go nuts. It can actually manage this inflation to an extent and doesn't have to go too far.
Yeah.
It's like there's always, what's the economist says, like there's a 50% chance I'm right and a 50% chance I'm wrong. So that's the caveat, is if they can't get inflation under control. But if they can, and it doesn't have to get too crazy, even with interest rates hitting 5-6%, I think you're going to be fine. But it's not going to come crashing down, but it isn't going to keep appreciating at 10% a year. I think there is going to be a couple periods where, I mean, even for like all asset classes, that things are going to just kind of level off for a while. Like we pulled forward a lot of earnings and appreciation in the stock market, in real estate, in pretty much everything these last couple of years. And now that they're trying to pull off and reduce the balance, all the overall money in the economy, that's going to kind of stable off and flatline things. So I think it is going to hit a couple of years, like to your point, like 2008. It's not the same thing. It's not. We dropped down and then we went up almost like the next year. I think we could see it to where it levels off, maybe drops a little bit, and kind of stays at the current rates once the things stop appreciating for at least 2, maybe 3 years.
So you're looking at the real estate market, right? And that's what we were talking about, the real estate market. But kind of what happened with COVID. When COVID first hit, we were having people ask us, how is that affecting your investment company? How's that affected you guys? And like we said at the time, well, right now it's not. We don't know when this thing loops around how it's going to hit us, how it's going to hit real estate. And it hit real estate very, very nicely, right? It boomed the market, it made everything go through the roof. So for investors,
By design, FYI, they wanted that to happen.
Yeah, they were pushing for inflation because they hadn't gotten inflation throughout the freaking, since 2008. They never got the inflation they wanted. So they were pushing for the inflation. They definitely they definitely got what they wanted. But my concern is more kind of going back to that premise of the pandemic, is all the other things that are also happening in the economy that are not necessarily real estate related, but will affect the real estate market regardless. So Dr. Dotzer, he gave off 7 points that he's looking at that are most likely going to affect. So you have massive monetary policy and fiscal stimulus at the same time. You have defunding the oil and gas industry. You have unprecedented labor shortages. You have China in a secular decline. You have working from home. Number 6 was changing community policy strategies, policing strategies. And number 7 was Fed will raise long and short-term rates fast. So he's talking about 7 things that they don't really have anything to do with real estate in itself, but these are all things that will affect the real estate market.
Things like I'm talking about, like real estate isn't a cause.
Right.
Real estate is an effect. Like real estate prices are causing a problem. Like 2008, real estate prices didn't cause anything of 2008. It was the lending against the real estate market that caused the problem. Stock market, that is different. It can have a cause and effect relationship, but real estate doesn't cause anything in my mind. It's like it's an effect because you can leverage it so high. And that is what causes problems of the interest rates that are involved, how much debt's posted against it, the underwriting of those loans. It's the lending against real estate that can cause issues. That's what 2008 was. So a lot of these things is like, the housing market. It's like, no, you have to look at what's going on around the world and then look at what's that going to do. And that's why, like for here in Texas, like we have people moving here drastically. I think we were second only to Florida of number of people moving here last year. I think the year before that, Texas was ahead. The number of job relocations, the overall policing strategies, like the energy production that can still come from this state. It's like there's a lot of things. He made a comment. He's like, I mean, the U.S. He's like plenty of times. I mean, the U.S. has been in recessions, and Texas just chose not to participate.
Yes.
I just started laughing. It was like, that is very, very true. I was like, hey, the U.S. is in a recession, but Texas is like, nah, we're good. We're just gonna keep growing and doing our thing down here in the South. So
Yeah, and then we go back to real estate being local, right? So like one of the points that he brought up was San Francisco Chamber of Commerce surveyed the people there, that half of the people that they surveyed will be leaving in the next 3 years.
that was crazy.
That's a massive stat, and it was from the Chamber of Commerce of San Francisco. It wasn't like, some random place. Like, it doesn't help the Chamber of Commerce that half the population wants to leave San Francisco in the next 3 years.
Yeah.
And they're leaving with money. Like, to your point, they're leaving with good salaries. They're selling their homes for a buttload of money.
For now, until
yeah.
like all of a sudden they're like, oh, nobody wants to move here, live here. It's like, shit, that's not good.
Yeah. So you have those shifts that you're looking at, and those are the things that you need to be paying attention to.
Well, just look at the jobs that San Francisco's lost.
Mhm.
What was it? They lost Tesla. They lost Oracle. They lost, what else was it? Their HP was another one that moved to Texas. Like those three moved here. And it's like a lot of big, and like those are just the big ones.
Yeah.
And I'm sure for every one big one, there's 3 to 5 small ones that have said, I'm done, I'm out. And like that was something that I just saw a headline for an article that San Francisco small businesses or downtown small businesses are struggling because tech workers aren't coming back to work. So like they're here, they got a coffee shop downtown next to like say the Salesforce Tower, and it's 20% occupied when it used to be 90% occupied. It's like your foot traffic's gone.
Yeah.
And that's what I think he's talking about, like the policing strategies of like nobody just wants to be in these downtown areas anymore.
Well, and you have that along with the work from home as well. That's
the other piece.
You have so many companies that are still doing those hybrids of work from home. They're decreasing in office space. A lot of companies like it because their overhead went down tremendously because now they need smaller offices. So even the companies have a big incentive to give their employees that option of hybrid work. So yeah, I can see how those downtowns get affected because it's like before you have everybody come into the office. Now it's like a fraction of the people are coming into the office.
Which is crazy. I was thinking about this today. Like the like the Federal Reserve and the U.S. government went too far with the fiscal and monetary policy the last 2 years. And that's the reason we have the problems we have now with the inflation is they went too far. That's why there's too much money flowing around chasing too little goods. Every business is trying to expand, and the U.S. economy is trying to go full throttle and expand, and it's not doing it. Like we don't have an immigration policy to fill these jobs that are open. And I'd look at the results like, man, how did that really happen? It's like, they used old data of what's going to happen if they don't pump that much money in. They're like, oh my God, everything's going to fall apart.
Mm-hmm.
It's like they didn't realize the technology that was there and how quickly it was able to adapt and shift to online remote work to get things done. Where like you have those examples like those tech companies and stuff. It's like, hey, we can go work from home. And then they pumped all this money to all these people that were sitting at home and still had their full salary jobs.
Yeah.
As like they used old economic indicators and tactics to try to fix new world situations.
Well,
and it was like we didn't need all that.
And that's why kind of when I bring up like when they try to use 2008 and stuff like that as a reference, it's like use it with a grain of salt because it's a different market that we're in. It's a different economy that we're in. Like I don't think the real estate market is going to react the same way. I don't think the world market is going to react the same way. I don't think things are going to be affected the same way. Like what's that saying? Like history rhymes, but it doesn't. It's not.
It doesn't repeat itself.
It doesn't repeat, but it rhymes, right? So it's like yes, there's going to be something of the sort, but it's not going to be exactly the same. So for everybody that's like thinking, oh, in 2008, this and this happened, so I'm going to prepare for that and that. It's like, well, no, that was 2008. Here we might have I do believe that we are going to have a very big recession and a very big market correction. Simply because like Dotzer, he brought up some good points, and that's something that like why the Fed pretty much wants to or will cause the recession to happen is they effectively need around a couple million people to be unemployed right now. to go on like pretty much just be unemployed, get fired. The reason for that is because in order to stop inflation, the way they look at it is they need to stop people from spending. They need to lower demand. If they lower demand, you're going to lower inflation, right? So we go back to the basic supply and demand. If there's too much demand for the supply, supplies go up. So if you can lower the demand, then supplies are going to come back down.
Well,
then it's going to cause that deflation.
Oh, for sure. And that's one thing I've been mentioning is like for real estate, like I'm looking forward to real estate not going up 10% a year, even 7% a year, because like it brings so many people that are chasing the money to our industry, and they create all kinds of problems for people that are. Sorry, the coffee's still a little hot. It creates all kinds of problems for people that are going to be in the industry for the long term. Like we've been this in for years. Like it's a passion for us. We work in real estate, but like everyone's like, oh, I want to be a real estate agent because I see you can make a bunch of money. Oh, I want to be a real estate investor because I see you can make a bunch of money. It's like, if you're chasing the money, this isn't the industry for you. And it's like, but it's allowed so many people for so long to get away with those tactics and rewarded them for it monetarily that they're staying in it. And just like, well, I can overpay for this property because somebody else is going to overpay for it even more. Yeah. It's like we need that clearing out of all of that garbage. And I mean, that's essentially what needed to happen for across all industries for some of these things that like, I mean, you look at in the crypto industries and several of like your big house flipping people, like your Open Doors and stuff like that, that they've been allowed to grow their businesses to unprecedented or at unprecedented speeds to unprecedented sizes for like, what are you doing? Like you lose millions of dollars every month, but yet you've grown your business to like 20,000 employees.
Well, because they keep growing. I look at companies like Open Door like a massive Ponzi scheme because the only reason they grow is they raise the next round of funding to be bigger than the last one to keep them going. Like they're not generating the revenues. They're always negative. So the only way they can stay in business is by getting dumber investors to come in at a higher valuation.
Well, because there's just more money out there, and people are just like, I've kind of loaded up on safe bets, and it's like, well, let's throw another 50 million at this company because there's a chance that it might succeed and do well. But it's also that's kind of like the West Coast model, where the tech model, where it's like, oh, look how many companies lost money. Amazon for sure is a huge one. Facebook's another huge one that they lost money forever as they grew market share, but they, in my mind, it's like they were doing something revolutionary and new. Open Door and a lot of these other companies, like they're not doing anything new. They're just trying to take something old and turn it into something new. And it's like, that's where I don't think it's going to work. But these people have been rewarded these last several years because so much money's been thrown into the market. They're able to go out and get it and raise it. And now you're having repercussions. And like the repercussions need to come from that because that money's being turned off. And that's where I think a lot of these places and a lot of these companies is like, and that allows newer, more sound companies built on better ideas that struggled up front to get funding to get ability to grow and expand.
So let me kind of prove my case on why I believe that this thing will get much worse economically and what that could possibly mean for real estate in the long run. So again, going back to it, he says like the Fed is pretty much looking for a couple million people to be unemployed to decrease their spending habits, right? So you look at that, and PBD put out a model that was, I considered it to be really good visual aid for those that are not like really looking at economics and everything like that. But he's like, lower spending habits from people cause lower income for companies. Lower income for companies cause layoffs. Layoffs cause unemployment. Unemployment cause lower spending, and it's just a cycle, right? Less spending, less income for companies, more layoffs, more unemployment. So Mark Dotzer, he put up an image of Superman trying to stop a speeding locomotive, right? Yeah. And everybody has seen that image. And he says the locomotive is the U.S. economy. Usually it should be running at like 60 miles an hour, nice and steady, everything's good. It got out of control. It's going too fast. It grew too quickly. It's getting out of control. So you have Superman, which is the Fed, coming in trying to slow it down. The problem is if you apply too much pressure, you're going to derail the train, right? Which is going to cause a massive problem. So just in my opinion, the way I look at it is every time the Fed has tried to do something, it's never really worked the way they wanted it. It's always overshot or didn't quite get there. Like they never really nail it because the economy is not something that you can just like work perfectly with some, with some pliers and it's going to be like, oh, there it is. It's perfect. Let's leave it alone.
It's like what's that? The poor drug. Papa Bear's is too hot. Mama Bear's too cold. Baby Bear's just right. Like, can't find a baby bear of the economy. It's like, it's too hot, too cold.
And that's not how the economy moves. The economy doesn't move, like it's too hot. Okay, now it's perfect. No, it's like, it's too hot. Well, now it just shot over to the other side. Then it shoots back over to the other end, right? Like it doesn't work in a very well-balanced way. So right now, the Fed was pushing for inflation. We got massive inflation. There's at the moment, there doesn't seem to be any end in sight to that inflation. We had JP Morgan, Jamie Dimon from JP Morgan, he came out and said how he expects by 2023, oil to be $150 a barrel. Like, that's insane. Like gas prices, let's say in Texas, they're at $4, they're going to be at least $6 plus. By the time oil hits that's going to cost even more inflation. It's going to cause things to be more expensive, right? Because oil is how you transport everything. It's going to affect transportation. It's going to affect a lot of things. So now the Fed is trying to raise interest rates. They're even talking about raising it a whole point now, because they're really trying to raise interest rates to slow this down. What's going to happen, what I'm seeing, is the fear in the market, right? People are not sure what this is going to mean. So they kind of make what the Fed is doing 10 times worse because they start preparing for the worst before the worst even happens.
Well, yeah, that's what they want them to do.
Okay, but that's what I'm saying. When you start preparing for the worst before the worst happens, then you kind of make the worst happen sooner.
No, because if you start preparing for the worst, then like what takes oil prices up? Demand.
Mm-hmm.
If people are preparing for the worst, that means they're spending less.
Yeah.
So they're getting ahead of it. My thing on the whole thing of this whole situation is, I was thinking about this, is like, I still think it's like they're going full force on trying to talk the market down, scare the shit out of people to stop spending money. Take that extra money that they have and like, ooh, I'm gonna hold on to this just in case. And that's how they're trying to bring it down. Because you think about it, if they aren't successful in slowing the economy down and people still spend, then they are going to have to raise interest rates to 4, 5, 6, 7, 8, 9, 10, 12% to get it. And now think about what that's going to do to some of the biggest assets on their balance sheets, like real estate. And it's like nobody's going to be borrowing money at that point. Nobody's housing prices are going to be underwater. Commercial buildings are going to be underwater. Now it is going to be systemic across the whole thing. So they are trying to rise interest rates. You got all your big people. You got the fear porn all over the internet trying to scare people into stop spending to create a soft recession, not an abrupt stop, because they will continue to rise interest rates to get ahead of inflation if they're not successful in being able to talk it down.
Yeah.
So if they're able to do that and people stop spending, then oil prices won't hit $150 a barrel.
You think that that's going to work? You think that we're going to have a very soft recession?
No. I'm not saying it's going to work. Like,
you are saying
that's what I think. That's what they're trying to do.
You're disagreeing with what I'm saying. You're saying that that's not going to happen. You're saying that what you're saying is going to happen. It's going to be soft.
I'm saying that's what they're trying to do.
I understand. But
I'm not saying that's what's going to happen. It's like that's what they're trying to do. And if they're successful in that, then I think we're going to be
What do you think is going to happen?
I have no idea.
I understand you don't know what's going to happen. That's why I say, what do you think is going to happen? You think they're going to be successful in that?
For me, it's too early to tell. Mm-hmm. I mean, the stock market's already off 20%. You've seen like crypto markets fall through the floor. You've seen sales demand, like everyone's stopping buying, they're pausing and stuff like that.
Yep.
And like to Dollitzer's points, what I like about his, like he gives way more facts and data and actual points versus any headline news, even PPD's 100%. Podcast. It's like, yeah, but you gave us just like, oh, this is what these people are saying. Okay.
It was his presentation was very dense
and that's where I was looking at what else, why would Jamie Dimon, Facebook, all these other people say things like this? It's like, because they have a vested interest in saying like, we need this to stop because if it doesn't slow down, it's going to get really bad. Mm-hmm. I mean, even Dimon says like, there's a hurricane on the horizon. We don't know if it's a Category 1 or Superstorm Sandy or whatever it was.
Yeah.
As like, so it's like trying to talk it out. Like, you guys don't understand. Like, it's not bad yet. And if we don't get this stopped, this is going to get much, much worse. So like,
so I think, you know, you would definitely do very well at being a politician, where you give an answer without giving an answer. So that's very good on your part.
I'd say it's more of an economist.
Yeah. Well, an economist, that's why they're 50% wrong, because they still make predictions. You know, it's just that exactly they make predictions. But you're not making a prediction. You're just saying what could possibly happen on each scenario, but you're not really saying what you think will happen. Like what I'm saying is like based on what I've seen, every time the Fed tries to do something or every time the government tries to intervene and force something in either direction, they usually fuck it up and it goes to the extreme on either side. So right now they wanted inflation and went through the roof and it's going to keep rising. In my opinion, inflation's not done. Like we're nowhere near being done with inflation. Right.
So I agree with that statement. So that's also, I think they want that inflation. It's like that's why they're not raising it too fast. Is like if they wanted to stop it, they could stop it immediately.
But that would be even worse.
But it's also, I think, and just like I've said this in the past, like they want to force inflation. They need it. We've gotten for 10, 12, 14 years, we've had 2% or lower inflation.
Yeah.
And it needs 2 to 3% every year.
Yep.
So it's like they're catching up for over decades worth of low inflation to wipe away the old debt. When you understand how the central banking system and everything works, like they have to have inflation to wipe away old debt to keep the economies growing.
Mm-hmm.
That's what happens when you have a reserve currency or an economy like the U.S. has. Is like, and they haven't got that. That's why they're wanting inflation. Everyone's talking about it and stuff like that. I think the Federal Reserve is kind of like, no, we need all of inflation because we've pumped in so much debt these last years, and like it's not risen enough to inflate away old dollars. We need money in the system to inflate away a lot of this old debt. And the problem is that creates massive polarity in the social classes. Because like they pump all that money in, and now you got people that don't know what to do with money, have money, and they spend it, and it all rises to the top again. But it does raise asset classes, and then for a while, it keeps things moving along.
Well, and that was something else that Dotzer brought up. Trying to look at it on the notes, but like he said something that we have Americans right now, as far as their household savings, we're record highs from what it's ever been before. It's like 40 trillion or something like that.
40 trillion, 7 trillion.
No,
so we're used to having about 1 in checking and savings accounts, and it rose to 7.
Yeah, it's some. I just saw it. Damn it. But anyway, but you're seeing people like that was one of the things that we've seen recently is people are taking vacations like they never have before. Everybody's going to Europe. Everybody's spending money. Everybody's like just living life, and we're starting to see that. That's the stuff that the Fed wants to stop. It's like you guys are spending too much money. You're buying too many things. It continues to inflate the market. But then going back to my point where I'm saying is like where I see the issue is that you start creating the fear in the market and you start creating this fear. And it doesn't usually like go like, oh, we're a little conservative. Let's just slow this down. It usually goes from fear to panic, and the panic is what throws things out of control. Like, that's my point. It's like when panic hits the market, that's when we're going to see these things get tremendously worse. And the Fed is going to lose control of what they're doing. And then they're going to have to course correct, so go back to buying mortgage debt and going back to buying all these things. Because I think it's going to be out of control. But that out of control part is what worries me, is that we don't know how long that can last. That could be a 6, 12, 18 months, 24 months out of control part that could cause havoc throughout the market. That then we go back to what happened to 2020. Everything shut down. How long has it taken for supply chains to pick back up and for things to get back up and rolling? And then you add inflation to that, and you add all the market issues that you had to that, and it made things even harder. In construction, we still are seeing and feeling all these problems. I mean, you had what was it, an email or something from CPS?
I have it right here. It was an email from CPS, and read it. And it says, "Good morning. We wanted to provide an update on our material watch list. Currently, we are closely monitoring the following materials for impacts to project schedules." This is our point when it comes to like real estate, like still drastically undersupplied of property. Currently, the largest risk to CPS energy projects is, they give a list of like electrical equipment of just like 75 kPV pad mount transformers, like a bunch of stuff that I don't even know what it is. But it's stuff that housing needs. Currently, the largest risk to CPS Energy projects is a secondary base enclosures. As we have exhausted the current stock of this material, this shortage has not yet resulted in work stoppage to 5 ongoing subdivision construction projects. However, we will not be able to supply power to approximately 800 new home sites by the end of July and a total of 1,600 home sites by the end of August when materials are expected unless additional alternate materials can be found. So that's saying that's 1,600 new construction houses here in the San Antonio area in the next 30 days that they cannot bring onto the market because they cannot find the equipment to give power to these places. So that's another problem that it's like it's a good and a bad thing. It's like, hey, it's a good thing for housing prices because we have a lot of people still moving here, and that's going to push up the existing home prices of the certain areas, even at these higher interest rates. Bad news is like they can't find the materials to supply these things. And you think about the chain that goes down. It's like that's another reason like they're trying to slow this down. They need to pump the brakes on demand. To where it's like they need those layoffs, like you talk about, to people quit spending money, so all these supply chains can get caught back up with material.
The issue that I see is going back to it is the economic machine, especially the American economic machine, is a big freaking machine. Well, it's not something that you can just slow down and speed up whenever you want. So then you have like my point is always that it's that. The amount of time, so you're slowing it down, right? It's most likely going to overcorrect and slow down way too much. And then for you to ramp it back up, like you're slowing it down when we still haven't fully recovered, right? Like we still have, again, what I was saying, like we still have supply chain issues. We still have delivery issues. We still have trucking issues. Like we still have all these problems in the market that they haven't really been resolved. And like even just the shipping from China, from other places, we still have those issues.
Well, that's just said that you're saying it hasn't recovered. The problem is it recovered too much.
No, it inflated too much. It didn't recover. Like the supply chains haven't recovered fully.
Because it accelerated too fast.
Exactly.
As I said, it's not that it recovered too quickly. As like the end consumer recovered way too fast to where the supply chains haven't been able to.
But that's what I mean. Like those companies haven't been able to catch up and adapt to this. And now you're going to add all these recession fears and all these problems. These companies are probably going to still slow down even further where they're going to be like, actually, we may not take on more truckers because we don't know what the hell this is going to be. We're seeing it with builders where they're starting to slow down their building. They're starting to not start as many houses because they're worried that they're not going to be able to sell them. So it's that fear in the market that I feel causes the recession and it causes it to be even worse because people are not sure what's coming.
Well, yeah, that's what they want though, but they're not laying off people. They're not stopping hiring. They're just not
They
hiring,
are stopping hiring.
They're not hiring as much.
No, there's a lot of what was it? Merrill Lynch, I think it was. There's a few major companies that have started doing some layoffs. Even Facebook, that they went down from hiring 10,000 people to now they were going to hire 6,000, and they might even lower that later. There's other companies that are already starting to look at performance, end of year performance, to see if they can start laying off people based on that.
Yeah.
Because they're all starting to prepare and they're starting to worry about what's going to happen. My thing is like kind of what we talk about. Yes, you should prepare. I'm not saying you shouldn't.
Yeah.
But the problem is like when you're talking about such a massive economy, that preparation is going to cause a massive problem to the whole economy that they're going to get the slowdown that they want, but it's going to be much worse than they think. It's not going to be that gradual slowdown.
To my thought is like, okay, they kill demand. Like all they're trying to do is kill demand on the end consumer.
Yeah.
That's what they need to do. Because I found that thing they were talking about, because I have the Dodger thing pulled up, where the U.S. net worth increased from 110 trillion to 150 trillion in the last 24 months. The average checking account balance normally sits between half a trillion and 1 trillion.
Right.
And now it's at 4 trillion. That's just cash in people's checking accounts.
Mm-hmm.
Like that is and that's why the Federal Reserve is rolling off at $1 billion a month, or almost $100 billion a month of cash pulling money out of the market and stuff like that. And it's like some of these necessary places. I mean, just like we're saying in real estate, it's like I want the market to slow down so I can do my business and catch up.
Right.
And it's like these companies, like trucking companies, supply chain companies, like I don't think they're going to stop. It's like, no, like that we want it to slow down because it's going too fast and I cannot hire people to keep up with the demand, and that's going to crush us. I want things to slow down so I can stable off and then grow from there. not trying to get smaller.
Yeah.
And it's like, I think they're just trying to like, no, like a trucking companies. It's like, I need people to be truckers. So as demand and orders get canceled, the need for truckers is going to go down, but it's not like they're going to start laying them off because demand is going to just plummet through the floor. As like, that's where I think they're trying to get things to do. They're trying to get it back down to normal level.
So here's an article that I had. Are home builders too pessimistic is the title of the article, right? And one home builder from Charlotte says, this recession is looking like and feeling like a big, long 5-year depression. Even Austin, no home buyer can resist Austin, right? Has a home builder declaring, sales have fallen off a cliff. We are selling a third of what we sold in March and April. The new home market is particularly sensitive to rising mortgage rates, and builders want to ensure that if they build it, someone will buy it. And builders are likely to respond to the decline in affordability and cooling demand by building fewer homes. This seasonally adjusted annual rate for May was 696,000 new home sales. May new home sales rate is below the actual number of 2021 home sales, which were 771. So that's about a 6% drop. But that says about how terrific 2021 was and how bad 2022 is.
Yeah.
Also, the annual rate of new home sales in May was 10% higher than the rate in April, suggesting, again, new home sales are not in free fall, just not as good as last year's.
Yeah, it's like Crimea River. You didn't sell as many homes in May as you did in March and April when you've been raping the profits and rewards these last 2 years.
Raping.
It's like, dude, like, I was talking to a home builder that I sold a new home earlier this year, and the guy's like, oh yeah, every week we're just raising it $10,000 more. Yeah. Like they're just killing it with these commissions. It's like the mortgage industry in 4, 5, 6, 7, and 8. It's like, oh, they were just raking in money because they're doing the liar loans and all this other stuff, and it's like, and all of a sudden demand fell the floor, and they're like, oh man, I lost it. Like that's your fault for not realizing, what you weren't doing anything special. Like there was this a inefficiency or a offset that's like you were able to get a bunch of cash. You weren't increasing your business. There was just a huge demand that you were able to reap rewards of, and you didn't see that. It's your fault that you went and spent that money thinking it was going to continue. Yeah. So like home builders, we're seeing a third of demand. Like, okay, why weren't you prepared for that? Back to what you historically were selling in 17, 18, and 19, not using 2021 thinking that was going to continue. And like,
well, and that's where I think like this article, this was actually a pretty good article that we read. I read from Housing Wire. All these links, we're going to provide them on the below in the description after this episode is over, so you can check out the articles. But when you look at the fear, and this is what we go back to before, when you're reading, if you're just reading headlines, you're going to freak the hell out. But when you start actually analyzing the data, like they're talking about the housing market is crashing, sales are dropping, all these things. Yes, when you compare them to 2021, it looks terrible. But 2021 was an insane year.
Yeah, prices were up 20%.
Exactly.
Like inventory was below 1.
You can't compare it to the best year in history. You understand? You got to compare it to the overall average. And when you start looking at the overall average, the market is still good. The market is still strong. But what's the problem? Like I was just reading the quotes from these big builders. They're all worried. So just because it dropped from last year's highs. So it's like if they're worried, they start building less. They're saying we're not really having an issue with labor shortages anymore because we're just not hiring as many people. We're not hiring as many laborers. We're not building as many houses right now. So they are starting to slow down because of the fear of the market going back to normal. Like it's not even cooling off where you're saying people aren't buying houses. No, they're just not buying them at the rate they were buying them in 2021. That's all it is.
It's like it's trying to normalize. Like it's still we're still sub 3 months of inventory, and in a healthy market, it's supposed to be between 4.5 to 6, depending who you listen to. It's like we're still drastically undersupplied.
And you're looking at at interest rates, right? Interest rates are near 6%. They're really high. People are freaking the hell out. But when you start looking historically, like before 2020 and everything, like the rates pretty much averaged out between 4 and 7%. Like those were normal interest rates. And the markets were fine and real. You had your net westerns of the world always doing 30 deals a month, and that was pre-pandemic. So people were buying houses. People were able to afford houses. The finances were different. But where I see, so when people just try to single out one little thing, I'm like, well, no, interest rates, they went up to 6%. Oh my God, what's going to happen? Everything's going to hell, right? It's like, well, it's not just that interest rates went up to 6%, it's that home prices also have gone up ridiculously. So now I did a post a while back that people were like, they never saw interest rates like that. That was like, if you target was a $1,200 a month payment at the time, you could afford, let's say it was like a $220,000 home or $250,000 home. Now, with the interest rates being what they are, now all you can afford is a $175,000 home for that same monthly payment. So,
by the way,
huh?
You said
no. Before, you used to be able to afford a $250,000 home for the monthly payment. Now, with interest rates going up,
you said 150. That's what I was like.
Oh, I said 150.
Yeah, you said 150.
250.
I was like, wait.
So when you look at that, now you are able, with the same monthly payment, you're able to afford a home of a much lower price. The problem is that home that was worth 250 is not now worth 175. It's still worth 250, maybe 265 right now. So you're looking at people that we talked about this before. People don't care about the price. They care about the mortgage. They care about what is that monthly cost going to be. If they can afford it, they'll buy it.
It's one of those, like, I remember them arguing with, oh, people care about price and stuff like that. It's like,
yeah.
Okay, people care about price because that's what the bank told them they could afford. That's what they care. But the bank is the one that cares about it. They might not directly like, oh, the price. It's like, yeah, because that's what the bank says they can afford via the payment into their finances. Like, it's still about the payment.
Right.
For sure. And it's one of those that we were talking with somebody, like, all right, when you go from March, April to May, June, mortgage rates were, I think, in the 4s or like 3 4s, and then they went into the 5 6s. That means the payment jumped. And for every 1%, I've said this before, for every 1% an interest rate goes up, a payment goes up 12%. Right. The housing payment just got 12% more. So if it went up 2% in 2 months, that means that house just got 24% more expensive, and now that person can afford less a house. And in March and April, things were still absolutely booming. You had buyers fighting over property, trying to get things, and just really going after each other. And you were getting beat out, getting beat out, and just getting beat up. And all of a sudden, you start seeing interest rates rise, and the house that you can afford starts going down. Those buyers are used to looking at $250,000 houses. And now they're saying, oh, you can't afford a $250,000 house. You guys can afford a $175,000 house. That is a huge drop in quality. Yeah. If you're dropping $5,000, $10,000, not that bad. But when you have to jump from getting beat up trying to buy your $250,000 house that you want, and all of a sudden your realtor says, oh, you can no longer afford that. You can afford these $175,000 houses. You're used to looking at these $250,000 houses for 2-3 months trying to buy one. And all of a sudden it's like, you can afford this. And it's like, really? I'm getting beat up. I'm tired of losing out on properties, and now I have to get this lower quality house drastically. I was like, I give up. I'm done.
So now to that point, I give up. I'm done. What do? They go rent.
And if you look at like our last market update, I think every single major metro was up triple digits in a commercial or multifamily unit construction. San Antonio's up 1,200% in 1 year as far as number of 5+ unit permits pulled.
Yep.
Every major metro.
We saw that. I mean, we went to Denver recently, right?
That was insane.
And what blew our mind, Denver is considered like one of the most expensive cities to live in.
Yeah.
The amount of apartment buildings being built in Denver was insane. The amount of cranes, apartment buildings being built like in the middle of nowhere, heading towards the airport where like there was just nothing there. You were telling me how you've gone back to you haven't
I used to
been
go there in like
Denver.
2013 when I first got my job, and it was like there used to be nothing between the airport and downtown. Now it's like there's housing developments and cranes every place. Like it was insane the number of, and it was apartments,
right?
Lots and lots and lots of apartments.
So here's the point that I'm looking at as you're saying that is that we go back to the issue that we have, which is affordability, right? So you have mortgage, your mortgage has gone through the roof. In Texas, even though we're energy and all this dumb shit that they try to fucking feed down your throat, which is full of shit.
Wow. How many cuss words can you drop in one sentence?
Are we testing?
I don't
Start
know.
a timer.
You dropped like 4 of them right there.
Well, it's just
like,
annoying because it's like, oh, Texas, we're so energy dependent. Get the fuck out of here. We are. And my energy bill has doubled this summer alone. And not just mine, but almost everybody that I know in their apartment building, except you, that you hijack your neighbors. But whatever. But you look at those things. So
inclusive.
Energy costs has gone through the roof. Grocery bills have gone through the roof. Gas has
7%.
gone through the roof. Yeah, 7%. I love seeing when economists talk about like the national. Groceries have gone up 7%. Like 7% on what? Well, if you substitute all this other stuff for this garbage, it's only 7%. Yeah, my ass at 7%. It's gone up a lot. Like we ran our grocery bill just from month to month. We're buying the same stuff. It's gone up almost 40% of grocery bill. And we're buying the same things. Yeah. Oh, if only we were
buying all the fancy cauliflower rice pizza crust.
Yeah. So you look at all those things, and it's like affordability is being a real problem, which is why it is that you and I feel so confident with Texas, is because even though all these things are going up, Texas compared to California, Seattle, New York, you're still so much more affordable. And we're having these massive companies are moving down here and paying the higher wages. So you're getting those higher wages that you probably were still getting those wages in California and New York. The difference is that money didn't go anywhere over there. But you come down in Texas and you have money left over now at the end of the month. So we're starting to see, those are the things that we're seeing as far as like, how is the real estate market? The real estate market in some areas are going to really suck. In other areas, they're still going to be doing very good, but you have that issue. Like we recently wholesaled a home. ARV was 140. That home was a dump. You know what I mean? Like it was a house that was like, holy crap. And the guy's an owner finance investor. That's why he's able to make that work and everything. But we looked at it and that was 140. And that's at a mortgage payment that some people can't afford. You know what I mean? Like he was saying, like even owner finance, he was going to owner finance it out for like probably like $1,200 for $140,000 home. That's like not in amazing conditions. So you're looking at that for a lot of people. It's like you have that, you have rising groceries, you have rising gas prices, you have rising electricity in the hottest summer we've had in I don't know how long. Like it's causing an issue for a lot of people. And now what's the next issue that we saw last year that we're no longer seeing now? People can't even refinance. Because before you would refinance, you were at 2%, 3%. Yeah. It made sense to refinance. Right now, you refinance it and you're refinancing it at 6%. So those people that are struggling, I think we're gonna start seeing a high rise in inventory.
Oh, I agree, and that's the same. Like especially next year when taxes readjust because prices are still up.
Explain that because you made that point before, and I think it's an excellent point that people need to understand. Like, why is that gonna affect it?
Okay, so the way Texas taxes work is they only Texas taxes work. Yeah, is they adjust the following year based on the prior sales. So for an example, in 2020 to 2021, prices rose like 8%. It's more than normal, but not as crazy. So those taxes, so they assess the house on January 1st of 2021. They say the house is worth X. It's gone up 8%. Those taxes set in and certify in July. Well, the escrow accounts for your mortgage do not adjust until the following year, usually around like March timeframe. So that takes us into 2022 is adjusting for the tax increases from 2020. There's a 2-year lag period in that. Now, 2021 comes along and they assess value of January 1st, 2022. 20%, 25%, 30% increase in your tax basis. So now that jumped your taxes drastically. And that doesn't certify until I think it's right around this time frame that those taxes certify. Now, taxes come around, they're due in October of this year, and all of a sudden the bank goes and pays the taxes for what the assessed value was of January 1st, 2022. and all of a sudden the payment went up 20-30%, or that value gone up 20-30%, and your escrow goes negative. Well, March comes around of 2023, and they assess your mortgage and they go, ooh, we're drastically short. We need to get ahead of this because they needed at least 3 months ahead. So we're going to take your payment from $1,500 and we're going to take it to $1,900 to fill in that escrow gap. $400 jump, just like that. Well, now what's that going to do is like people are going to be like, man, what the hell? Okay, I can eat that. I'll figure it out. I mean, it's put a lot of stress on them, but they'll figure it out. Well, now comes around to 2023 after another year of, let's say it's not 20%. It goes down to 15%. They do that same scenario again. 2024 rolls around when they assess for based off that value, and that's when payment just went up another instead of $500, it went up $300. Your payment in 2 years just went up by 60% to fill in those gaps. That's where it's really going to hurt people.
Yep.
And that's where I was thinking around 2023, summertime into 2024, that's when you see a lot of people that have bought in these last 5 years of people just or the first-time home buyers that bought houses that didn't realize the repairs that go into these things. Yeah. And they bought a house, say it was I bought a flipped house, and because I was fighting for these houses, the sellers didn't have to repair anything. You want the house, buy it. I'm not going to fix all these things.
Yeah.
And now they got to fix these things over time, draining their budgets, and then the payments now gone up almost double. It's I can't afford this house anymore. I'm not getting paid 40% more. I'm getting 10-15% more, but not 40.
And that's when you're going to definitely start seeing those, especially those migrations from the coastal cities and stuff like that. When those taxes start coming in and start hitting because for them it's going to be
coastal cities are completely different.
What do you mean?
Because their tax rates are significantly different out there. Theirs are more based on price. That's why California homes are $2 million, and that here the same house is an $800,000 house, the same payment. Their taxes are way different out there because we don't have a state income tax. They do. So their taxes aren't going to be drastic. It's the price. That's why prices over there swing so much more wildly. For here, and I've had this kind of opinion that's why our housing market's more stable, is because our taxes are attached to our homes, and they are a lot harder to shoot through the roof and shoot down because the cash flow that you can rent your house for is more stable because you don't get $800-900 in that spread.
Right.
So that's why it's it might not be because of taxes out there, because their tax rates are significantly different than ours here.
And this is also going to be a problem for those homeowners that are all right, let's, things are getting crazy. Let's just stay still. We're fine. We have this home. And then all of a sudden your mortgage company comes back and says, hey, you got to pay us an extra $300-400 because your taxes went way to hell up. And you've been staying still, not doing anything. And now all of a sudden you're negative.
Well, insurance rates, and you got insurance rates in those too, that they're going up as well. So those payments are going to get very, very, very expensive, and you can't refinance out to a lower mortgage rate because people they're not known for being financially responsible, saying hey, you can afford a $250,000-300,000 house. That's 40% or 45% your debt to income. People go by try to squeeze out a $310,000 house.
Yeah.
Well, yeah. Can I get to 46% because I really, 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 really want this house? And it's well, you're doing it, but you're stretching your budget and you're within the laws. That's where it's going to get very painful. And that's where I think inventory is going to come onto the market. But as long as there's people coming behind that because as long as housing prices haven't fallen, somebody might have been able to appreciate 10% because that might be what it costs to sell the house on the open market. And somebody comes behind, as long as interest rates aren't, that's where I say if interest rates continue to climb and they cannot get this under control and rates start hitting above 7 or above 6.5, 7, 8, 9%, that's when you're going to start having huge problems, is because now that's really going to start weighing down. That's why I think they're trying so hard right now to almost begging their knees, please just stop spending money.
Yeah.
Please look at all this stuff that's bad. Look over here. Look at all these headlines, how terrible it's going to be. Just chill.
Yeah.
To let the supply chains even out, because
we see that, we definitely see that with them. They again, they've been trying to talk the market down. They've been trying to talk people from spending, and it seems to have had the opposite effect. It's like your dad telling you you can't do something and you go and do it anyway just because you want to do it. Because this summer, the amount of traveling people have been doing, the amount of traveling they've been doing to Europe, buying shit, going places, expensive trips, it's insane. It's insane the
Well, it's
amount of
also
traveling people been
for
doing.
me, I look at it like, man, I should go buy all this stuff now and backstock it before prices get more expensive.
Yeah.
So it's like I'm spending more money to try to get ahead of where prices are going to go.
Yeah.
It's like the same thing with the freaking teepee shortages. It's like people are like, oh my God, I might run out of toilet paper, so I'm gonna go buy it all and hoard it. And it's like people aren't.
I
like,
thought you meant like actual teepees. I was like, who the fuck is buying teepees?
how did you go up? And we're talking about
You
the
said
economy.
the teepee shortage. I picture like an actual teepee.
That's where you went. Yeah, toilet paper shortage, teepee shortage. You went to Cowboys and Indians. You went back in time.
I was like, who the hell's buying teepees?
Oh, 1,000 years. You're just like, well, I'm gonna go back that far, or not 1,000 years, but
Wow.
like Jesus.
Whoa.
But
Say
like,
toilet paper, okay? It has an actual name.
too many syllables.
But yeah, but then that is a good point, right? Like you're seeing people even create worse inflation because they're right now they're like, let me buy these things while they're cheap because they keep hearing and seeing that prices are going to keep going up. So let me buy, let me prepare, let me stock up. So it's like you're kind of driving the price up faster.
So it's like one thing I just thought of this. The money that was printed is still in the hands of irresponsible people. The money has not made it to responsible hands yet.
What does that mean?
So you look at somebody like ourselves, like our Airbnb and stuff like that.
Yeah.
We're getting income from that Airbnb, but we're not turning around and immediately going out and spending it either. We're just holding it. It's sitting idle. The velocity of money
You didn't
is
buy a
slowing down.
Lamborghini?
No, I did not go out and buy a Lamborghini and go #hustle. Just yet. I didn't go out and spend it. It's like the money has not, because that's what the velocity of money is. What's too high right now? There's too much money changing hands between people that aren't being responsible with it and just holding on to it.
Yep.
So that is like there's too much money in irresponsible hands, and that's what's keeping this demand going. Is people going on these vacations, going crazy instead of like, dude, how about instead of spending money, you contribute to an IRA that you haven't done? Is like the average savings, like people will start contributing to their company 401ks till like 37 years old, or something like that. It's like, how about you take that money and you put it somewhere that you've been neglecting the last several years?
Yeah, Bitcoin.
But they don't do that.
Yeah.
They still go out and they go buy cars. They go buy all this stuff, all this consumer products, because that is the American way. It's the consumerism. Like that is the problem. It's like it's too much money in irresponsible hands, and it hasn't made it to responsible hands yet. And the Federal Reserve is now has to come in and pull that stuff. That's what PPD said. He's like, these next several years, he's like, this is where great wealth can be made. If you're smart, actually provide real value, and don't go spend it on stupid shit, you can make generational wealth. Because he's like 40% of all the money in the U.S. economy that's ever been printed has been printed in the last 2 years.
Right.
So that money's out there flowing around to people's hands, and it's jumping hand to hand to hand to hand. And if you're smart, you can make sure a lot of that money that's just jumping around can end up in your bank account. And if you don't spend it, throw it out to other stupid people, you can build a business and you can build assets, you can build reserves, you can do all those things and make sure some of that money ends up in your pocket and not just keep spreading around, and because it's going to end up in responsible hands.
No.
It's what it always does. It
Always.
always ends up in people that are business owners.
The problem
investors.
is that what you're saying is the issue that we discussed at the last podcast is when you talk about responsible hands, you're most likely talking about the rich, right? Because
That's stupid.
They're rich for a reason, right? So the problem is that what we talked about is that we're going to start seeing that gap between the rich and the poor, especially during these transitions, get even wider.
Well, I was saying like the polarity between social classes is going to continue to go further.
And that's what politicians are going to be catering to. They're going to be catering to like, oh, but look how broke you are. We're going to help you. We're going to give you this. We're going to give you that. And it's like, that's not what's going to solve any of the issues. What's going to solve the issues is that you start taking personal responsibility for your finances, and you start understanding that's like, hey, you know, we kind of live paycheck to paycheck. Yeah, we have a little bit of a savings account because we had all these child tax credits. We got all these stimulus. We had all this working from home, so we didn't have to travel. We got maybe a pay raise. So we got all this. Instead of throwing it on a freaking European vacation that we pretty much can't afford, like, why don't we do something smarter with that money? Why don't we invest it? Why don't we even just keep it in cash? I mean, when something like this happened, a lot of things are going to go on sale that are going to be great to buy as far as investments and,
Bitcoin.
Bitcoin. That's still a thing, guys. So I think you talk about a very excellent point that is where we try to help people the most is get financially educated. You know, don't stick your head in the ground and pretend that everything's going to be fine. Don't assume that the government is going to come in when things get bad and they're just going to give you
Or
money
there's
again.
jobs everywhere.
Yeah.
I was like, oh, I can quit this job and go find another one over here. I was like, you don't build any loyalty, you don't build any skills at that point, don't build any resiliency. It's like, that's one thing. It's like the market is too hot as people are getting too cocky. And there's like, well, I don't need this job, I'm gonna go over here. But you're not working on yourself and growing yourself. Same thing with like your wealth and stuff. Like, you're not taking money and putting it into yourself and saving it for a rainy day. You're not taking this time preparing for the bad times by making yourself more marketable when jobs get tight. Or you're competing against 5 other people. It's like, well, these last 5 years, this person in their resume, they jump, job to job to job. It's like they're chasing the money. They're not chasing the lifestyle. They're not chasing the education. Not chasing the growth. Now, if you, these last several years that everyone's been doing that, you might have been doing that too. But you've been working on yourself and actually not allowing the market to reward you just because the market just needs a body in that position. But you're actually being better for those jobs, and that's why you land those jobs, not just because the company just needed somebody.
You're going to see that issue, especially when the market shifts. Let's say things do get really bad. Then you try to go for a job, and a company looks at your resume, and they're like, you bounce around a lot from job to job. Like, I don't think you're a very stable person for us to hire.
And as long as, like I say, like that's what I was saying, job to job to job. If you don't have a good reason why you were jumping from job to job to job, it was just like, well, they were paying better, I didn't like this work environment. It's like, no, they needed these set of skills, and I went and worked on them and had them. And that felt was underappreciated at this company, and I went and developed myself. I took these courses outside of my job. I made myself better. That's why I moved from job to job to job.
Right.
Like, if you can't say that, yeah, to your point, like, you're not loyal, and you're chasing money.
And then
you're gonna be liability.
we've even brought this up before, where right now you have so many investors that we know ourselves that they think that they're full-fledged real estate investors simply because every deal they've done, they've made money on in the last 2 years. And it's like, everybody's made money in the last 2 years. You know what I mean? Like, you haven't taken the time to actually understand, like, hey, I've been actually buying pretty risky deals. You know, the only reason I've made money is because the market's been pulling me out. You know, I'm buying deals that I shouldn't have bought at the moment, but yet when I was done with the project, it made sense. Like, I hear that so much from investors where it's like,
they don't understand why they made money.
Yes. They get into it, and the excuse I hear all the time, and it just, like, you know, irks me, is when people say, well, I just want to buy a house to renovate and flip because that's how I learn. You know, I learn by doing. Like, but that makes no goddamn sense. Like, what do you mean you learn by doing? You don't know what the hell you're doing.
Yeah.
What are you going to learn? Let's say you did that house, you flipped the house, you made 10 grand. You're like, okay, well, at least I made 10 grand. Well, did you know that you could have made 50? You don't.
Yeah.
Because you don't know what you don't know. You don't know what you did wrong.
You never spend any time learning the the underlying fundamentals. You just saw that I made $10,000. It's like, yeah, but how did you make $10,000? And that's fine. So people, like, they do learn by doing, but you can't just learn by doing and not try to learn how other people do it. If you're not trying to self-educate about your job and how, because that is your job.
Yeah.
If you're a full-time real estate investor like we are, we learn by doing every time, but we're asking how other people are doing it. We're in masterminds with other people. We're reading history. We're understanding, like, what makes this industry tick. How does it work? Why did we get paid what we got paid? Hey, we built a house, and our original ARV went from $275, and we sold it for $330. I was like, why did it go from $275 to $330? It's not because I built a better house.
Yeah.
It's because the market appreciated rapidly because of things that were going on at that time. I'm not now trying to think I'm God's gift and I'm going to try to do that every single time.
Well, and then also asking yourself, it went from $275 to $330. How much was I in it for? Like, would I have still made money if it had sold for $275?
Exactly. Yeah.
Because that's how you and I, every time we analyze a deal, is where's the market right now? The market is at $275. Okay, how much do we need? What's the repairs going to be? All of that. We analyze our numbers. If everything stays the same, does this house make sense? Yes. okay, then we jump in. If it doesn't make sense, if it's something that's like, oh no, we would probably lose some money or you know, maybe break even. But guess what? You know, in 3 months from now, the price could go up another 20 grand. So then we'll be good because then we'll be in the money. Like, no, that's not a deal that you buy.
One of our coaches put something in a way that I'm just like, I really like that. It's like, well, here's my profit margin. Don't think of it as a profit margin. Think of it, what's your margin of safety? Of just saying like, hey, I'm in it for my margin of safety is like, I'm going to be in it for 250 and I can sell it for 300. My margin of safety is at 50,000. That's not my profit margin. That's my margin of safety where before I start dipping into my reserves and things go backward very quickly. And it's like that right there. When they said that, it was like, I like that. It's like, oh, what's your profit margin? It's like, no, my margin of safety is 10%, 15%. It's this amount. And it's like before I now have to really be like, where do I get this
that
money?
can get wiped with anything, a price drop, you know, extra days on the market.
Interest rates went from 4 to 6.5 in 2 months.
Yeah.
And
I mean, we saw that,
climbing.
and that's why builders got into so much trouble is because they started building a house, and we saw how long it takes to build a house. For a lot of builders, it's been taking over a year to build a house because of material shortages and stuff like that. And it's like they were building a house for this homeowner that had gotten a quote for their mortgage at 3%. Now all of a sudden their mortgage is going to be 6%. They can no longer afford the house. So now it's like the builder's halfway done or done with the house, and they can't sell it to their buyer because the buyer can't afford it.
That buyer.
Yeah, that buyer can't afford it. So now they got to go out, but that's a risk because it's kind of like you're building it on a pre-sold, you know, concept that you're like, okay, I'm good. And then you're finished, and now you're like, shit, now I got to go look for a buyer. Well, you know, now I gotta try to find something. So it's one of those things that, and I'm not saying that's good or bad. What I'm saying is like, those are the possibilities.
Well,
those are the things that can happen.
Well, it's also what I was saying as far as home builders go is they're pulling back because they can almost control their own, almost can like segregate and control their own market. Because after 2008, and it's just the point to like oil and gas exploration and stuff like that, like Dotzer talked about, is like, nobody wanted to be a home builder after 2008 because nobody came and bailed out the home builders.
Right.
So that's why we got so drastically undersupplied of homes where we're not building homes anywhere near at the pace that we need to. And nobody's going out to being a new home builder right now.
Yeah.
Same thing with like gas and exploration. Where it's like, you guys need to drill. You guys need to drill. You need to get more oil in this so we can bring gas prices down. They're like, no, I'm not going out and spending billions of dollars and all of this stuff when I am your number one punching bag as far as like your climate change initiatives and all these things you're trying to do, and you're decreasing subsidies and you're beating. I'm not going to go out and spend this. I'm trying to survive. Why would I go out and spend all that stuff to help you out when you turn around and just punch me in the face? Like, that's not going to happen.
Yeah.
And so home builders are the same way. It's like they got beat up in 2008. Like, these people aren't stupid. They run multi-billion-dollar, some trillion-dollar companies because they're smart.
Yeah.
And they understand how these things go. So, yeah, they're going to pull back because by pulling back now, that means they're not going to get overbuilt again. And that means that they can survive and weather the next storm. If prices go up, they have the balance sheets to withstand that stuff because people still need housing. And it's going to put it on the government, create it. The government's going to have to solve it. Now, they're going to have to come out with some stupid stimulus package that taxpayers are going to have to pay for so people can afford houses again. Giving big vouchers, 40-year mortgages, changing things around, giving home buyer credits. Maybe it's not first-time home buyer, it's second-time home buyer credits. Whatever it may be, to change the market to where people can fill those things, because the home builder's like, I'm just not going to build.
Mm-hmm.
Or the government tries to step in, that'd be the worst thing, and they try to fill that gap and build, and like then that taxpayer's going to pay for it too, because they cannot build houses efficiently.
No.
They build a house, like, we're going to sell it for $300, it's going to cost them $600 to build it.
Yep.
And they'll lose money, and where's that go? Taxpayer.
Well, so now let's talk about a topic that would help everybody listening. So you're hearing all these things, all these headlines, everything, and you're like, all right, so we might get a recession. It might be bad. It might turn into a depression. It might not turn into a depression. You know, it might tank the housing market. It might not tank the housing market.
For the first time, the Fed might actually just create a soft landing, and we just ride off into the sun.
Yes, and everybody will start riding unicorns. So you have
I would like to
all
ride a
those.
unicorn.
I bet you would. So those are all the things, right? These are all the hesitations and everything. So now, as a real estate investor, as somebody getting into the market, what is it that you can do to prepare for whatever is to come, right? So John made a good point where one of the things that we've done with the profits that we've been making is actually reinvest it in our own education. We've joined 2 coaching groups. One is on mindset and the other one's on real estate. And these coaching groups is to further increase our network with people that have vast amount of resources, people that are in different markets, people that are doing different types of investing and strategies and stuff like that. So what we're doing is preparing ourselves with the network and with the community that we're going to need to weather whatever storm comes about. So it's one of those things that we're working on our mindset, because when these things happen, this was one of the points that PBD brought up that I thought was a really good point. He says, when a crisis hits, you have 3 types of people. One, those who shut down. These are the people that panic, and if they have a business, they shut it down. They don't know what to do. They panic. They freak out. These are the people that don't do anything. Then you have those people that just survive. They just go into survival mode. Maybe they get side hustles, extra job, whatever it is, just to make ends meet. And then your third group are the people who come out of it stronger, right? So what we want you to be is those that come out of it stronger. In order to come out of it stronger, you need to work on yourself. You need to work on your mindset. Your mindset is so crucial right now, because the things that are going to happen, they're going to be whipsaw in your head back and forth, and you're not going to know which way is up, where to go, if you are reactive to the market. What we are more looking at is how do you be more, what do you call it, where you anticipate the market more than you react to it. Yeah. You're more proactive, so you're anticipating. You're preparing yourself. The things may not go that bad. It may not happen at all. The market may not crash. Everything might just level off, like you're saying. You know, it might level off. Things are going to get a little bit, okay, it's a little slower, whatever, but that's about it. Great. Nothing happens. You are fine either way. But in case it does, are you prepared for that? Are you financially prepared? Is your household prepared? Are your finances prepared? Like, are your expenses, the way you manage your money, the way you invest your money, are you prepared? Your investments, the way you invest, are you ready for that? We've already reached out to some of our buyers. We've gotten a few deals, and they're like, I don't know. I'm kind of on the sidelines right now. I'm not sure what's coming. I'm not sure if I want to buy a property right now. They're acting scared. They're worried about what's happening. I don't know if what they're doing is right or wrong, but I think not doing anything isn't the answer either. You know, because this thing is coming whether you like it or not, you know, whatever's going to come. And it's like, if you're not doing anything, you know, I heard this saying before that's like, if you want everything to stay the same, something's got to change. Because if you don't change, things don't stay the same. They actually get worse. You understand? So if you want things to stay the same, something's got to change. So I don't want you guys to be paralyzed. So what are some things that we are doing besides we got the coaching, we're educating ourselves. What are some things that we're doing that you've been doing, let's say maybe in the finance department, in our operations, so we can better prepare for whatever comes down the line?
I mean, it's just understanding your finances. Like, where does your money go every month?
Mm-hmm.
Like, where are you spending it? It's like, hey, I have money in the bank account. Yeah, you have money in the bank account, but how quickly do you burn that money? Like, where is it being spent within your business? And it's like, okay, this is discretionary spending. I could cut my budget by 20% if I needed to. Because like, it's one of the things, one of the guys that I follow, and one thing he always said, there's like 2 type of economics environments: bad times and preparing for bad times.
Right.
Like, there is no good times. And it's like, no, when it's good, that's when you should be preparing for the next time around it gets bad again. Mm-hmm. That's what smart people do. That's what investors do. That's what business owners do. It's like, hey, things are going, but I'm not going to spend recklessly and go out and buy my fancy Ferrari because I deserve it, or show Rolexes because it looks good on Instagram.
Right. And to that point, this is not to say that you guys can't live a luxurious life. By all means, live it if you can afford it.
Yeah.
Don't buy that expensive vehicle or take that crazy vacation or buy that huge house if it's going to tap you out or get you pretty close to tapping you out. That's like, well, if all this thing, like, if the business slows down, I lose my house.
It's like understanding why you make money the way you do.
Yeah.
It's like you said, like, go buy it. If you can afford it and you're like, yeah, I get my money from this source, what kind of value and what's your stability in that company?
Yeah, we recently, yesterday, we did our quarterly review, right? We reviewed all our finances. What is our monthly burn rate? What is it that money is going into? What kind of marketing? What are the marketing channels? And we started analyzing and kind of stress testing. Like, okay, if we lose this marketing channel that's generating this level of revenue, it's like, which other one can we go into? So that's what we've been doing in the good times. In the good times, we've been expanding. Where I've spoken to so many investors, especially recently, that they're in direct mail. All they do is direct mail, 100% direct mail, right? And it's like, well, it works. I'm like, until it doesn't. Oh, it's always going to work. I'm like, wow. Talk about being a gambler. It's always, nothing always works. Things work for a certain period of time and then it changes and then it shifts and then it's, things work in different ways. So it's like, direct mail is working for you. You're killing it right now. Awesome. Why don't you implement SEO, cold calling, text messaging? I mean, anything else to go supplementing that, just in case direct mail stops working, you have another avenue that you can tap into. And people are not looking at it that way. This one thing works. It's been working for the last year or so. So I'm only going to do this one thing. And that is it. And those are things that you and I, like, we've never done. We do single family. Right now, what are we getting educated on? Warehousing, strip center, office buildings, multifamily. We're starting to look at other asset classes. Because when the market shifts, single family might take a hit, but maybe retail starts picking up. Maybe warehousing is what's picking up. There's always the money's gonna go somewhere. It doesn't evaporate.
Yeah.
And
wealth, is like money doesn't destroy it, it just changes hands.
Exactly. It's gonna go somewhere.
Like, the only thing that destroys wealth is the Fed Reserve taking money off the table. That is money disappearing from the market, and that is coming from somebody's pocket and not going into somebody else's.
Right.
But if they stop doing that, and all that money they printed out, that 2, 3, 4 trillion, however many they done, man, it's like, if they're only pulling off 100 billion a month, that's 1.2 billion a year. That means that for the next 3 years, they would have to keep that pace to take all that money away. They're not going to do that, because that money and that wealth is changing hands, and it's going to go in somebody's pocket. When the stock market has fallen through the floor and it's lost $2 trillion, money didn't disappear. It just went into somebody else's hands and went somewhere else.
Well, I even think PVD brought up that point that I found funny. He's like, how crazy it is that as the Fed funds have risen, so has the stock market risen the same way. Where it's like most of that money that the Fed print goes straight into the market. A lot of that money goes into the market. So it's like if they start making that money disappear, the market tanks. You know what I mean? The market is propped up by a lot of the money that the Fed has put out into the market. So going back to it, when you come up as a real estate investor and you're looking at your investments, right now is not the time to take on the speculative investments. Right now is the time for you to be smart. Start investing in your education. Start investing in yourself. Make yourself healthy, mind and body. Because what's going to be coming down the line is going to be perhaps very, very stressful for a lot of people. If you don't know how to manage that stress, it's going to consume you. You're going to be one of those people that you're not going to know which way is up at that point.
Well, so it comes down to understand where your money comes from.
Yeah. And if you do understand that, if you do prepare yourself and you think about it that way, you're going to thrive in whatever comes next. Because guess what? The majority of the people are going to panic. The majority of the people are going to struggle. And that's your opportunity. As an investor, you're going to have a lot of motivated homeowners. That's where you can come in and help out these motivated homeowners, figure out what the next steps are for them. You're going to be able to pick up real estate. You're going to be able to do deals. You're going to be able to help investors. Right now, you should be working with your buyers list, building your buyers list, building your connections. For when the market shifts, you have a good, strong buyers list that you can depend on. Because most of the buyers that we've been seeing right now that have been outbidding every single project, every single property, they're going to be gone.
They don't understand. They don't understand money and how it comes from. They don't understand why they're getting rewarded for the effort they're putting in.
They're purely speculative. They bought real estate just because it's going up and it goes up. That's it. That's their only reasoning.
It's what the analogy is like. Money is made in good times. Wealth is made in bad times.
Hmm.
And it's like understanding where that stuff comes from and who your buyers are and why they're buying and do they know what they're doing? Yeah. How long have they been investing? How many houses have they flipped? They're 2-3 years. They're just getting started. They're making money. It's like, all right, they're a buyer, but I don't think that buyer's going to be buying when things get bad.
Yeah.
Because they're the type of people that I made money, so now let me increase my lifestyle. I'm going to go buy that fancy car because I made a bunch of money these last 2 years. And it's like, That is a depreciating asset. That is not a savvy thing to be spending your money on.
Yeah. So, I mean, definitely learn. I mean, we go back to it. What's going to get you out of this is financial education. Financial education, personal education, like in the biggest thing. And I mean, we've said this, I don't even know how many times in how many episodes, podcasts, everything we've done. It's all on your network. If you get a quality network, I'm talking about quality, real investors, people that have been, we know people that are multimillionaires, have been investing in real estate for decades. These people have seen market cycles. They have survived market cycles. They have built massive companies. And you look at the way they come up, the way they build these companies, they're very slow. They're very meticulous. They build a strong foundation.
They're not the dudes in the 3-piece suits. I'll tell you that right now.
They're definitely not.
They're the dudes in Crocs and jeans over standing in the corner Hawaiian shirt.
Yeah. And I mean, the two people that we use right now that we rely a lot on their counsel and everything, I mean, they're short sneakers, T-shirt, like that's when you see them. And these guys are dealing with tens of millions of dollars every single month of real estate.
Yeah.
You know what I mean? Like they're doing a lot of volume in single family residential, warehousing, multifamily. And they're not the fancy people that you're going to think of, the ones that are pulling up in their Ferraris or their Lambos with their, really skinny jeans and all the bullshit that they wear, right? Like
really skinny. How skinny are really skinny jeans?
Well, it looks like they're wearing fucking leggings and shit.
The ones where they jump off a chair to hit the ground and pull.
I haven't paid that much attention, but
you say really skinny jeans, like what is that?
But those are the people that I tend to not listen to. When I see them pull up in they're doing a video and they're pulling up in a new car or some shit, trying to flaunt that. And by all means, I'm not hating on them. Like, credit to you that if you can afford that Ferrari, great, own it, enjoy the hell out of it. You deserve it. But my problem is these people that they're using borrowed money to buy these things because they haven't built a business. And they're showing you the glitz, the glamour of real estate. And it's like, but you have no foundation. Yeah, and we've even seen it recently with one of the local douchebags from here that used to preach real estate, and now they're preaching Amazon, Shopify business models or whatever the hell it is that you do on Amazon now. And it's like, oh, you get better returns than real estate. I'm like, what the hell are you doing?
And then like the LLC name is still something about cash home buyer or something.
Yeah. So you look at that, and again, how do you prepare for this? Build a strong network, build yourself. Mindset is everything. Your mindset, how you're going to deal with problems, how do you problem solve? How do you do critical thinking? Do you have a network of people around you that when you want to do a move in your business, you have these people you can bounce these ideas off? Right now, we did our quarterly retreat. We put down a bunch of action items. What are we going to do now? We're going to take all those action items. We're going to break them down into how we're going to implement this. And then we're going to send it to these people. We're going to say, hey, here's where our business is at. Here's where we want to go. What do you think? What are your opinions? And it's not that we're relying on what they tell us to do, but we value their opinions.
Yeah.
Because these are people that have been in it, again, 10 plus years. They're making millions of dollars constantly. They have millions in reserve. Like, it's not that they're fully leveraged and they have no cash available. No, these people are ready for whatever comes down. Like, whatever happens, they got the money. They have the system. They have the people.
The knowledge.
They have the infrastructure. So it's like, that's the kind of investor I want to be, right? That's the kind of investor that you and I keep working to be, is we work a lot on our systems, on our foundations, on our people, our whole crew, everybody that we hire. We're always taking care of them. If we make more money, they make more money. We try to create that company culture that no matter what happens, they're looking out for us. We're looking out for them. We try not to make it those just money hungry cultures. That's like, well, if you want, you guys got to hustle, you got to grind, you got to, hashtag blessed and all this nonsense and ring the bell whenever you hit a deal. It's like, no, it's a company culture. It's about like, do we all click? Can we work together? Or do you have to worry about your teammates stealing your deal? Stealing your, the buyer that you just brought in? Like, those are the things that you got to get away from, and you got to go towards building the foundation to your business, right? Anything that you want to add to that?
No, you just killed it.
Just killed it.
That was it.
And if you're listening, give us a thumbs up and subscribe if this is your first time. We also have a text community that you can text us anytime, any questions you have. Just text YouTube to 210-794-9898. And we're always there just to answer whatever questions you may have, whatever things you're dealing with. But right now, we are, just to give you a little insight to our company retreat, we are growing our marketing channels. So before, our marketing channel was pretty much 100% text messaging and cold calling. We're starting to see a shift in text messaging. We're starting to see that it's become a lot more complicated. It's become a lot harder to do. There's a lot more requirements, restrictions, and everything, certain amount that you can do. We used to do large volumes. I mean, we would send out probably 50,000 text messages a month. So now that's been cut down drastically. But we have grown our SEO side. We've gotten some deals now. We're starting to get deals from our website. We have grown direct. We've done a little bit of direct mail, testing that out, adding that into our features. We've done door hangers, where we've got these professional door hangers done by Ballpoint Marketing, and they're like handwritten door hangers, and it's handwritten by a pen, a computer that uses an actual pen, so it doesn't look like ink. It looks pretty cool. We're testing that out. We're going a little bit heavier also on cold calling itself. And what else are we doing? We're doing YouTube as well. We're doing some YouTube marketing. We're reaching out to our network of wholesalers. Pay-per-click. So we've been taking all of our income, all of our profits, and reinvesting it in other streams of marketing, how else to generate leads. Right now, like I said, we've been doing single family in a certain demographic that we were targeting in single family. Now, based on our buyers list, we're actually going to expand that out to lower end homes that we are not necessarily interested in, but we know buyers that are interested in those lower end homes. What that allows us to do is not just wholesale those properties to them, but learn what it is that they're doing as well. We get to learn how they analyze deals. What strategies are they doing? How are they implementing it? Not that we want to do it, but we want to know in case the market shifts, and that's where we got to shift into. We got to shift into maybe doing owner finance deals, right? I mean, those are the things that we're looking at right now. We have one of our coaches that he does warehouses, multifamily. We started looking into that, right? Because now we have a coach that if we get any deals in that area, we're going to bring it to him and say, hey, we got a warehouse that, this is what you do. Can we partner on it? Where they can show us how to do it. And that is extra income. That's another system. That's another stream of revenue that we can generate. Because again, our goal is to build an investment company. Our goal is not to wholesale houses. Our goal is not to just look fancy on Instagram. Like, our goal is to build a legit investment company that builds our portfolio, builds our income, builds our cash reserves to the point where we are able to buy all these investments ourselves and keep them for continued cash flow and appreciation. And especially when you have these markets that go on sale, we're able to buy great assets and really grow our income in our portfolio. So I hope you guys are taking note, and I hope it's helping you. And if you have any questions, like always, reach out to us. We're here to help. Do y'all personally answer your text community messages? Yes, Dylan. I answer them myself. It's 100% me. And if there's ever anything that you ask that's related to John Barr, he'll jump on. But yeah, it's us directly doing it. That's why we did it, just so you can have more of a dialogue with us directly. So you can always ask your questions, whatever it is that you're concerned about, thinking, worried about, strategies, deals. On there, we also share things that we don't typically share to the public, because sometimes we don't want these things to be out in the public. Like, we've dealt with some shitty buyers, and we share that with you guys, how you can protect yourself against those things. And we don't necessarily want to share them publicly because those shitty buyers listen to our stuff. So we're not in the business of bashing people online like that. But that's the point of the community. It's to help you guys grow. It's to give you more of a resource and more of a platform where you can definitely reach out and ask questions. He says, I ask because I'm a local realtor in the San Antonio area and would love the opportunity to meet y'all. Yeah, we do. Also, we do property walkthroughs. where we send out a text, let you guys know that we're going to be walking one of our projects, and you can tag along and you can ask us, how we picked it up, anything about financing, managing contractors, managing the scope of work, the rehab. We cover all of that on these property walkthroughs. If you've been following us for any period of time,
we're hosting bi-monthly meetups as well, starting here in the next couple months. So I don't know what month it starts. I think it's gonna be, the first one's gonna be July. August I think is the first monthly meetup. We're not sure the location yet or when it's going to be or anything like that, but as soon as we do, like, pay attention to our stuff, and we'll definitely post it. It'll be well known when we start doing that stuff. We have a bi-monthly mastermind as well, but you have to be a part of the same brokerage that I'm a part of as well.
Yeah,
So,
you can come in once as a guest, so you can check it out, but that brokerage is Stepstone Realty. The reason you have to be a part of it, because that brokerage it's not your typical brokerage. They're investor-heavy brokerage, where the majority of their investors are all, their agents are all investors. That's what these masterminds are about. We talk about different strategies in the investment realm. We have different speakers. Everybody on there is an agent and an investor, so it's a great community to network, be a part of. I always tell every agent that wants to be in real estate investing to really consider joining that brokerage. It's the only one of its kind that has the ethics and the morals that you can actually, go behind and work with. So definitely consider checking that out. And we'll follow us on social media, on our text community. We'll be letting you guys know exactly when these meetups are going to happen, where, and you guys can definitely join us that way. But we always sit down with investors. We love helping you guys out. We love sharing what we know. That's all we do, is share our knowledge. Like, we're not giving you theories or, hypotheticals. It's just our personal experience with what we're doing, what we're investing in, and what's working and not working for us. That's pretty much all we cover. So I hope that helps, Dylan. With that said, if you don't have anything else, I think that's pretty much it for us today.
yeah, I mean, that's really all I got.
All right. So as you've seen, we're not doing these very frequently. We kind of wait around for to have more meaningful topics to discuss, because you look at headlines, they change all the time. A lot of it is just clickbait. So we don't want to be wasting your time with things that don't matter. When things matter, we will jump on here and create, do a live. You can jump on, ask us questions, and we'll cover those points. We'll cover everything. But in the meantime, always reach out to us. We're always here to help. And with that, I say good luck to everybody. Hope your investing goes well. And
Stay educated.
Stay educated, for sure. And you do that by watching our channel. That's all we do. We share all our strategies on there. We don't hold anything back. So get educated, get knowledge, work on your mindset, work on yourself, and you will do great. So with that being said, thank you all for watching, and we'll catch you on the next one.
Bye-bye.